What's up, everyone, and welcome to week 2 of my experiment to see if a simple, data-driven investing system can beat the S&P 500 over the long term. If this is your first time here, I'm not trying to predict the next hot stock or trade in and out of positions. I built a simple system that ranks what I believe are some of the best companies in the world based on valuation and quality. To evaluate these stocks, I use a formula that ranks analyst upside and PEG ratio. And every week I invest $100 into the highest ranked opportunities. If you want the full explanation of how the system works, check out week 1. That's where I break everything down. So let's go ahead and look at the data for this week and see what was happening in Tier 1. As a reminder, the companies I have in Tier 1 are companies that I consider to be best of breed, proven, established, and companies that I would be comfortable owning for a very long time. The first category we're going to take a look at here is analyst upside rank. To determine analyst upside, I take the median price target that analysts have for the stock, and I compare it to the current price that the stock is trading at. Number 5 in this category is Constellation Energy, which is trading at 42.7% below analyst forecast. Microsoft is trading at 45.68% below, while Nvidia is number 3 at 48.74%. Number 2 is Micron at 56.62%. And holding down the top spot is Oracle at 74.63% for analyst upside. The next category is PEG ratio. The smaller the PEG, the better, with anything under a 1.0 being a pretty attractive valuation. So the top 5 are Meta at 0.89, Oracle at 0.62, Broadcom at 0.54, Nvidia at 0.46, and Micron with a minuscule 0.04. After combining analyst upside and PEG ratio, we get opportunity rank. Top 5 on this list are Meta, Microsoft, Nvidia, Oracle, and Micron. Using my system, I will put $20 into each of the top 3 stocks on this opportunity rank list. So I purchased Micron at a cost basis of $963.18, then Nvidia at a cost basis of $203.57, and finally Oracle at a cost basis of $144.54. That does it for Tier 1. Now on to Tier 2. The Tier 2 list are excellent companies that have more volatility than Tier 1 and maybe are still working on building their competitive moat. The top 5 for analyst upside on Tier 2 were Synopsys, ServiceNow, Lumentum Holdings, Palantir, and Netflix. The top 5 for PEG ratio were Blackstone, Synopsys, Netflix, ServiceNow, and Lumentum Holdings. And that brings us to the opportunity rank, where we have a top 5 of Palantir, Synopsys, ServiceNow, Lumentum Holdings, and Netflix. For Tier 2, I'll be buying 2 stocks. First, I purchased $20 of Lumentum Holdings at a cost basis of $776.65. Then I purchased $20 of Netflix stock at a cost basis of $74.57. If you tuned in last week, you might have noticed that I bought the exact same 5 stocks that I did last week. That's it. No market predictions, no panic, no hype. Just following the process. I said it before, I'm not trying to be a stock picker. I want the data to tell me when great companies are trading at attractive prices. The companies in Tier 1 and Tier 2 may change over time, and the rankings will definitely change, but the process won't. That's what I'm really testing here. Can a simple, repeatable system outperform emotional investing over the next 10, 15, or even 20 years? We're only in week 2, but every long-term result starts with consistently making the next right decision. I'll be back next week with another $100 investment and an updated opportunity score ranking. If you want to follow the journey and see whether this strategy can actually beat the S&P 500, hit subscribe, and I'll see you in week 3.